Right then, we will get started then. You might have just seen the channel. Yeah, do let us know where you're you know, checking in, calling in from. Perth, Sydney, Melbourne. Good to have you all. And if you want to let us know what your business does, what brings you to the webinar today, aside from the obvious topic, would love to hear that from you guys. Obviously, today we want to make sure you walk away with some practical insights you can actually use for your business. We're going to look at reading your numbers, understanding financial reports for business owners. If you've not seen me before, my name is Connor. I actually lead our company registrations team and legal and accounting subscriptions team. But today I am your host. So during the presentation, we will answer a few questions, but we do have a slot of time at the end of the presentation for a Q&A. You should see there at the bottom of the screen a Q&A text box. So please add your questions in there. But if we do run out of time and we're not able to get to your question, or you just actually want to you want to basically make your interaction with us a bit more personalized, more tailored to your business, you may be eligible for a free accounting call with one of our accountants, funnily enough, in our tax and advisory team. However, for instance, if you're an accountant on this call, just brushing up on your knowledge, I'm sorry, you are not eligible. But if you've completed the poll there, we can kind of determine your eligibility there. However, if you're interested in chatting to one of our senior chartered accountants as quickly as possible, please type yes in the chat box, and you'll most likely get a priority slot. So let me introduce them. I'm thrilled to introduce our presenter, Tim Quinn, who is the head of our tax and accounting team here at Lawpath. Tim himself is a chartered accountant with deep expertise across accounting, business structure, tax planning, budgeting, and financial analysis. He does, lucky for you guys, work with small businesses every day, helping them make sense of the numbers and making smarter decisions as a result. So if you ever have looked at your financial report and you thought, I know this is important, but I'm not quite sure what I'm looking at, you're definitely in the right place with today's webinar. And I know I'm buttering up, but Tim does have a real gift for explaining these concepts in plain English without all the jargon. And then what are we covering today? So Tim's going to walk you through the three core financial reports every business owner needs to understand. Those would be your profit and loss, cash flow statement, and balance sheet. We'll quickly explain as well how to read and interpret your cash flow, because as many of you may already know, profitable businesses can still run into cash trouble if timing isn't managed well. And we'll also look at profit margin, and performance trends. So what to watch for, how to spot warning signs early, and we'll also cover the basics of that balance sheet and what it tells you about your business's financial health. And then finally, we'll discuss how to use your numbers to make those better decisions. So whether you're planning for growth, you might be preparing for a loan, or simply running a tighter ship. We'll hopefully get through all of that. And for those of you, I will repeat myself here, but for those of you who have just joined in a bit later, just to say again, we will wrap up with a live Q&A. So if you have any questions, we'll try and answer them as we go. Feel free to drop them in that Q&A chat box and we'll get to many as we can at the end. But before we dive in, you can see here on the screen a little bit about Lawpath. So for those who may be new to us, we are a platform. We provide smart, simple legal and accounting solutions for small businesses. Yes, we can absolutely do some ad hoc work like traditional law firms or accounting firms, but we're an online platform that helps you create legal documents, manage your compliance obligations, register business names, companies, ABNs, trademarks galore. And most importantly, we allow you through our subscriptions to connect with lawyers and accountants on demand, all in one place. And so you can see there, this number is actually a bit higher now, but we've assisted over 500,000 businesses and saved over half a billion in legal fees as well. So whether you need a contract reviewed, help understanding your tax obligations, or like today, guidance on your financial reports, we're basically here to support you every stage of your business journey. So without further ado, let me hand things over to Tim to take it away.
Thanks very much, Connor. Plain English, Connor promised. Plain English is what you get. And also plain English is actually my nickname for Connor in the office. So it's great to have you back. Long time off the bench on the webinar team, but it's great to have you back. And thank you everyone for joining us. Very important topic, very liable to get dry. So I'll try and keep it spicy. We'll try and give you some real insight, and we'll avoid a bunch of jargon. Why are financial reports important, given that they are quite boring? If you don't understand them, if you can't reliably look at yourself in the mirror and say, this is what this report means, you are going to have no clarity. If you're only looking at these financials once a year because your accountant's been nagging you and is telling you they need you to sign, it's too late to do anything about the information controlled in it. I'm going to help you flip your mindset. The financials aren't just another little bit of documentation that you sign off at the end of the year. There's something you review as you go. You take lessons from it. You build out your budgets, your expectations, and no surprises. This is what we want to get to. And it's just going to make you more confident in the way you run your business. So it's going to be super important. I will try and keep it exciting. We're going to run through 3 main financial reports. 2 of them, I dare say, anyone who's ever had to sign a tax return or a set of financials has seen before. So your profit and loss and your balance sheet. In between that, and I think we've put it in between for a reason, is your cash flow statement. You're only getting part of the story if you're looking at your profit and loss and your balance sheet. Profit and loss will show your performance over a period of time, whichever period you want to have a look at. Balance sheet tells you point in time, this is what you got, this is what you owe. The cash flow statement bridges those 2 reports and is actually the most useful report for small business owners. And it's the one that they teach in accounting right at the end, right in the last accounting unit, when you're bored of all the drudgery. Accounting 3B is when you learn cash flow. But small businesses need to learn it more importantly than any other report. I'll talk you through that in a bit more detail. I really like to think about accounting as a language. I am not going to make you fluent in this language by the end of this presentation. What's the little owl bloke, the cartoon owl? Duolingo. I don't know if that's his name. I'm going to give you the Duolingo version of the accounting language. You don't need to know all the ins and outs. I see there's a few bookkeepers at least on the call today. You don't need to reassemble T accounts or know your general ledger. This is just about the outputs of this accounting language. This is teaching you enough to ask for dos cervezas, por favor, in a bar in Spain. I'm just going to give you the essentials. Accounting is a shared language, and if you can speak it, you'll be speaking the same language that lenders and investors speak fluently. So if you get to their language and you start to talk the way they expect to be talked to, it's going to make your life a lot easier. So you're not going to master it yet. Some of you never will because you've got more exciting things to do in your lives. That's why you hire an accountant. But the outputs are important. How do they work together? We mentioned that the idea of the cash flow is the bridge. The profit and loss will measure profitability. Oh, what else do you need to know? If you're making a profit, what's the drama? You will very quickly see that that doesn't take into account cash. You can be making all the profits in the world on the books on your profit and loss. It can look great, and you can still go bankrupt. You can still go bust. Why is that? Why can a profitable business be really hurting? Well, you're profitable if you record all of your invoices, forget about who is actually paying them. So you could be out there making $1 million, but until the money is actually sitting in your bank account, you've got expenses to pay, you've got bills to pay and nothing to pay them with. So the profit and loss is a great place to start, but it doesn't stand alone. The cash flow statement actually tracks the ins and the outs. It's a very stark report that says, this is what's coming in, this is what's going out. It really simplifies. It is the simplest of the 3 financial reports. It's usually the shortest, and it's often the most important. Your balance sheet is more of a longer term proposition. When you're assessing a business that's been operating for a while, you want to see how it's grown over time. You want to see the core foundational strength of your business. Your balance sheet will show it. It's a snapshot of what you got, what you owe at a particular point in time. It's really, really important for all 3 of those to be considered together. Like I've already said, this isn't a once off and dust it off and forget, put it in a bottom drawer. These are live documents. If anyone's out there using Xero, excellent cloud accounting package. If you're on the Lawpath platform, you'll see that there's an offer in there if you don't use it already. They run these reports so easily. It's built for non-accountants to be able to go in there and run these reports. So I encourage you to go and do that. Go and have a look today if you've got time. Wait for me to finish speaking first, please. Don't interrupt. But afterwards, do go and check out your Xero and run these reports. We recommend in my team looking at your profit and loss at least monthly, looking at your cash flow statement even more frequently. Xero has great dashboard capabilities, so you can see that literally every time you log in, a condensed form of your cash flow. And looking at your balance sheet less frequently, at least once a quarter though. No small business owner is perfect. They've all got conflicting demands on your time, but these are the common mistakes we see when it comes to financial reporting. Like I've said, only checking once a year and only because your accountant's begging you to. Looking at the top line and thinking everything's good, looking at your revenue without thinking about expenses. I will tell you that I've looked at many failing businesses, many failed businesses, and the odd successful one too. And what the ones that have turned around performance can show almost universally is that they've been really tight on expenses. Revenue isn't always that easy to control. It can be out of your hands. And if you take a razor to your expenses, I dare say there's always something that can be cut. Now, don't assume as well that profit equals cash. That's the whole point of the cash flow statement, to really emphasize that those two things are not. And also, don't just leave these as static documents. Go back and review, compare them. Anytime you run a profit and loss report, you can select multiple comparative periods. See how things are going. Sure, this quarter, that's useful, but how were they doing same quarter last year? What about 2 years before that? Really, really useful to review how things are changing. Let's start with the P&L. It's a big, juicy one. P&L, or profit and loss, or you might have heard it called an income statement. They all mean the same thing. You select your period. Often you look at it as an annual. Over that period, it will tell you how much you've earned, your income, what expenses you've incurred, and the bottom line. What's your profit position or loss position? Hopefully it's a profit position. We hope so. It's the most obvious measurement of business performance. It is, if you're making consistent losses, the business is not going to survive unless you turn that around. If you're making consistent profits, fantastic, good for you, and good for anyone who wants to lend you money, importantly, or is looking to buy into your company. A strong P&L over time, consistent P&L showing profits, showing growth, is a great company to lend to. It's a great company to invest in. We break it down, and I'll show you a demonstration of this before. It's not terribly complicated, I say, having looked at these things and dreaming about these things every day of my life since I was 17 years old, but they're reasonably straightforward. Starting from the top all the way down to the bottom, revenues up the top. Cost of goods sold, we treat as the direct costs of actually delivering that revenue. You can think of it almost like variable costs that will depend on your level of sales. So if you're selling bread and revenue from bread sales is revenue, your cost of goods sold will be flour, butter, things like that. The exact direct expenses that tie to your income. Your gross profit is your revenue minus those cost of sales. So gross profit is a really important metric, and someone on the chat is going to ask me, what is a good gross profit margin? I'm going to wait until someone asks, but I bet you do. And I'll give you the same answer that I tell everyone. It depends on the industry, but a very typical business that this metric works for both people selling stuff and selling service. This is true. And it's also someone for a bakery. 50% gross profit is a fantastic metric to aim for. I'm not saying it's universal, but you might think, wow, 50% profit, how phenomenal. You know, who out there in their right mind is making a 50% gross profit? Well, we haven't talked about our operating expenses yet. Your operating expenses are things like your rent, often your wages, marketing, administration, things like that. So you take your 50% profit margin, you think, great, that's fantastic, but then you got to subtract all of these other expenses. They're not directly tied to the selling of your stuff. Take the bakery. I just realized I called it a bread shop before. I must have sounded like an idiot. Take your bakery. Your rent doesn't go up or down depending on how much bread you sell. It's a fixed cost. It's an operating expense. Um, it's not relevant directly to your revenue, but of course it counts. What's left at the end is net profit. That's the bottom line. That's a really important number. That's where we hope it's more than zero, and anything more than zero is good. This is what that P&L looks like. So it's not terribly complicated. If you've never looked at one before, it looks a bit foreign, but that's okay. As you see, like we talked about, top to bottom, revenue all the way up the top, cost of goods sold. Out of that comes your gross profit. This is a terrible example of a sample P&L because you can see it's got almost no cost of sales. So there's very little to there. There's a huge gross profit. I dare say that this is an example because it hasn't been properly coded. So it probably needs to be fixed up. But you can see there big operating expenses. So this business where you've made $48,000 of sales and a gross profit of $48,000 quickly becomes a net loss of $9,000 because of all of those expenses. So if I was a business owner and this was my business, I'd get the razor out and I'd start trying to cut from your operating expenses. I'd go line by line and say, did we really get the value from the $4,000 of legal expenses? Or maybe we just had to incur it and it was a one-off. Could be. Wages and salaries, is there fat there? Do we really need to have $40,000 of staff to deliver $48,000 of revenue? Potentially not. Potentially that's not sustainable. You can go through yourself and see exactly what these things are. That's what business owners do. They typically go through that exercise with their P&L. Guys, great questions coming through. I'll just answer them at the end though. So good motivation to stick around. All right, so what are we looking at when we're looking at these P&Ls and certainly comparing it to prior periods? We're looking for growth, ideally, growth of revenue, not of expenses. We want consistency. No one likes looking at a P&L if you're a lender or an investor, or if you're just interested in your own business's health, where it's really choppy. Fluctuation is a sign that you're potentially relying on a few clients, so you're potentially not diversified, or relying on external factors. We love to see consistent top line growth. If it's choppy, it's not as reliable. We think, this month is great, next month could be a travesty. And that matters when it comes to loan serviceability. How are you going to pay back your loan repayment next month if it's a bad month? So we love consistency. We love, ideally, we know expenses go up. We understand inflationary pressures, particularly at the moment. But ideally, expense growth is limited to below our revenue growth. If we're seeing bad news is okay. Bad news is only terminal if you ignore it. Bad news can actually lead to improvements in your business. So if you're seeing expense growth, find out where it's coming from. Is it coming from your wages or something else? Is there something that we can target based on what we're learning about our business? Next thing, look, gross margin improving over time. We love to see that. Of course, you're an attractive proposition if you do have an improving gross margin. But also, are there some one-off expenses in your operating expenses that really distort how things look for an ongoing business? For example, that last one we looked at, those legal expenses, okay, $4,000 of legal expenses and only $48,000 revenue. It's not great, but maybe it was a one-off expense. You've put all of your agreements in place. You've actually spent that money very wisely. And when I would be looking at that to look at trends and look at next quarter and how is the business going, I'd strip that out and say, well, it's spent now. I'm not going to be spending it again. But it's all good as long as you're actually reviewing, as long as you're seeing this information and understanding it and putting it in the context of what you know about your business. Here's a practical example. Fantastic, my business revenue's grown up 25%. Bad news, the net profit has decreased. It might be that you've had to, in order to build up that business revenue, outspend on marketing. God knows marketing is expensive. Our own internal marketing team tells me how much Google ads cost, and I almost had a heart attack. I understand that that is something that you sometimes have to spend in order to generate revenue, but potentially you do it in fits and bursts. Potentially you say, well, let's sit back and consolidate. Our business revenue's gone up, but we probably need to turn the tap off on marketing spend for a little while. But again, you don't have to, but if you know it's there and if you view it, then you can actually do something about it. Another example here, and we'll really touch on this when we come to cash flow. Your revenue's up 15%, but your cash is down the toilet. Your cash has dropped 30%. This is a very, very common problem for small businesses, particularly in small businesses that sell to big businesses. And if anyone who has had the pleasure of dealing with a really large retailer, and I won't name them, if anyone can drop in the chat their experience in terms of what are their payment terms and when do you actually get cash in your account, you will understand that this is a real problem and that cash is not the same as profit. So it's just a reminder that the importance of not just tracking your profitability, but checking your cash and tracking your cash is incredibly important. We've had a few people all drop in 90 days from end of month. Yes. And what happens on, in terms of payment terms, what happens on day 89 when their accounts payable team calls you up and says, you didn't fill out the purchase order requisition properly or whatever, there's always an issue. And then they say, well, we now can't pay you till next month's invoice run. That's just the way we do things. And you might think, well, why on earth would I be dealing with these large retailers? Because you have to. You're sort of beholden to their own practices. So if you're a small business and you're out there selling on 90-day terms, well, great. Imagine to asking your employees, can you pay them 90 days late? No, you can't. You've got to pay them now. What about the ATO? People used to try it on. The ATO doesn't like that very much. It's really, there's a mismatch. And so when you're budgeting, and when we talk about cash flows, we'll demonstrate this, you really need to budget your cash flow, not just your profitability. Yeah, Christopher, Connor, I'm agreeing with you there. Those 90-day terms are horrendous. But they can use their market power and get away with it. All right, cash flow management. This is the really the pointy end. This is the really important one to consider for the reason we just talked about. In this scenario with this business here, we've got a $40,000 profit recorded. Fantastic. There's only $5,000 in the bank. How's that happened? Well, like I said, we've issued invoice, but they haven't been paid. In the meantime, that $5,000 is expected to cover your bills coming in, your wages, your superannuation, your GST. All of these things have to be paid on time. There is no way around it. In the meantime, you'll have a lot of sleepless nights because it's saying, I don't have the money to pay next month's payroll, next week's payroll. I need these invoices to come in before these things are due. Otherwise, I'm going to be in big trouble. That $40,000 profit business could be bankrupt. It could be trading insolvent. So very, very important to consider your cash flow. The actual cash flow statement is split into three. Depends on your sort of business as to which of these will have the most cash flow. In a typical stable business with low overheads, most of it's going to be in your operating. So your operating cash is cash in from selling your stuff, your services or your goods that you supply. It's showing the cash going out to pay your wages, your rent, to pay your tax, things like that. It's your day-to-day expenses. It's the norm. It's what you're doing. Investing is if you're in a business where you need to buy things like property, plant and equipment or stuff or fixtures, motor vehicles, whatever it is. In a cash flow statement, we separate. We put this in a section called cash flow from investments because we recognize that these are potentially not ongoing. Depends on what sort of business you are, but it's useful to say, well, these are not operational costs or if you're selling some of those vehicles off with cash coming in, it's useful for you to track it separately. Likewise, when we're talking about financing, it's no good saying, well, our cash flow is good because we've got $1 million more cash if that $1 million was just a loan coming in. To tell the full story, we need to separate out cash flows from financing opportunities. So what are some early warning signs? And again, early warning signs are only useful if you're in your books and if you're having a look at these reports. If your what we call debtor days are increasing, which can mean, which is just a measure that says how long are you taking to get paid. If that's increasing or just your general dollar value of debtors is increasing, it means that your customers are paying you later and later. and that cash is not able to be used by you. It's sitting in your customers' pockets instead of in your bank account. Big warning sign. If you've got an overdraft, overdrafts are great in short-term bursts. If you need it there, it's an easy facility to use. But if you're always at your overdraft limit and sometimes exceeding it, that's probably a bad sign. And of course, you would know why. Is there supplier pressure? Are we seeing that you're actually paying your own things late? Maybe you are fracturing your relationships with your suppliers. That's that's a bad sign of cash, a bad sign in terms of your cash flow, because it suggests that those relationships will deteriorate and a key part of your business will not be available to you. A big problem that we often see with struggling businesses is that they've relied on the bank of the ATO, which used to be open for business, and it used to let, during COVID, there was a direction to basically stop chasing small businesses, and a lot of people really abused that. And so we're seeing a system now where the ATO is coming back and is chasing debt very, very, very quickly and very stringently. And they're putting penalties not just on companies and businesses, they're putting them on directors. So I encourage you to have a quick look, if you can stomach it, at one of our webinars recently from, I think, December or maybe November. It's up on YouTube about the director penalty regime, the DPN notices that people were getting. Some of these tax debts can be transferred to you individually as a director, which is a scary thought. What can you do about it? You just make more profit, make more money was what it was a famous American politician that's how you deal with problems of not having enough money. Just go and make some more. We live in the real world. What can we actually do in our business beyond waving a magic wand? Something you can do, go and change in your practices right now, is make sure you invoice straight away. There are still some small businesses out there that will only invoice once a month. I think that's madness personally. If you can actually, if you go into Xero and raise an invoice, it takes 5 minutes. You can hire a bookkeeper to help you do this. Small changes to your practices, but invoicing very quickly, even invoicing in advance on milestone payments, depending on your sort of industry, it gets that cash quicker into your account. Don't just don't sit there and let them languish. Xero, again, if you can set up automatic reminders for these invoices, get them chased every week. Don't just do it once a month. Don't only do it when you go through and see how many 90-day debtors you are. Just automate it. Some people think, or certainly it used to be, people used to feel a bit nervous about chasing their customers, and it's just, geez, it's a bit impersonal, isn't it? You got to get out of that mindset. That money is yours. If they're late paying, they've agreed to payment terms. You've got to enforce it. So that's something that you can go and do today. Here are some ideas that can take a little bit longer to implement and to actually feel the reflection in your bank statements. Look at your payment terms. Are you offering unreasonably generous payment terms? What happens when your customers are late paying? Do you have in there the ability to charge interest? Do you enforce that? Do you even offer discounts for payments on time? Some people do. I encourage you to have a go with it. See what happens. We have also recommended the idea of separating out bank accounts. If you're the sort of small business that is really on top of their cash and can just keep everything in the same place, you don't need to do that. But some people find it easier to squirrel bits away to pay your tax bills. Put aside 10% of your revenue, if that's a common metric that you see, to pay your tax debts. I leave it up to you as to whether you actually action that, whether you think you need to. And most importantly, start building in cash flow forecasts into your monthly processes, into however often you're doing the admin for your business. Look at your forecasts, see how accurate they are. A lot of people will do a forecast or a budget, and then it sits in a drawer and you never have another look at it. At the end of that forecast period, see how you went. It'll help you building out next quarter's forecast. It'll let you understand where you're probably too negative or too positive about your business's outcomes. So I think that's a really useful thing to build in. And thank you, someone in our chat has shared the link to that director's penalty webinar if you are interested. Now, the last but not least of the three statements that we're going to look at is the balance sheet. What's your balance sheet? It's your point in time. It's your business's health. It's a really stark, straightforward statement. I think of the three, it's probably the most obvious to understand for a first timer. So it shows what you've got, which we call assets. What do you owe, which are liabilities? And the last bit that no one ever looks at, but it is actually quite useful, it's the residual interest, or basically what's left over when you take your assets and subtract your liabilities. If you've got a very, very simple scenario, $1 million of assets, $500,000 of liabilities, your residual or leftover is the money you've put into the business and the profits that you've generated, minus any profits you've taken out. Probably the least useful of the three. Most people understand assets and liabilities. It makes sense. If you think about it from a personal perspective, you know what you've got in your wallet, you know what you've got in your bank account, you know how much you owe your brother, you borrowed because he bought you a case of beer last week, whatever it is. In terms of assets and liabilities, they're easy to understand. So let's stick with them. A balance sheet is not a balance sheet between this state and this state. It's just at this state. So it doesn't measure performance. It just measures the outcome of that performance. It's where is my business today, based on everything that's happened from day dot to today. It's very, very important to look at for liquidity reasons and solvency reasons. You guys would know, if you're company directors and that's how you run your business, that you have a duty to keep the company solvent and a duty to wind up the company if it is insolvent. It is a very important document, therefore, to have a look at. Is my business solvent? Can I pay my debts as and when they fall due, looking at this balance sheet? It's a good measure of financial stability as well. So lenders and investors love balance sheets. It particularly for more established businesses, because it shows, okay, not only has this company been performing for a certain period, which a profit and loss is, it shows where is a business up to after it's been running for this time. It is a really strong assessment of how likely am I going to get my money back if I invest in or lend to this company. And the ATO doesn't mind having a squiz at it either. If you've ever needed to lean on the ATO for a payment arrangement, they'll probably ask to see your balance sheet. So, like we always mentioned, mentioned, we've got the assets. We do break them down into current and non-current. So most of your assets for most businesses will be current, and they're basically anything you can convert to cash inside 12 months. Your non-current assets are things like your motor vehicles, your old, your property, plant and equipment, things that in the ordinary use case, you won't convert to cash in any particular period. So for most businesses, that there's not too much of that. In terms of your liabilities, we do the exact same thing. We split between short-term obligations due within 12 months, and everything else goes in non-current. So typically your credit card balance or any short-term debt that you've got will be in there. If you've got a 5-year business loan, we'll typically put that in non-current liabilities. And like I said, equity is what's left over. Don't spend too much time worrying about it. Here's your balance sheet. Now, this is an interesting one. I love this example because it's a bad business. It's a bad balance sheet, but it's quite a good demonstration of businesses that you'll see that have potentially been doing their own accounting, or and no offense to suburban accountants, potentially they've used accountants without the requisite experience and knowledge. There's a line in there, and I'll wait and see if anyone can pick it up before I draw it out. But let's look at the bottom line. The bottom line in this business, whenever you see brackets in accounting, it means negative. We have negative net assets of almost $17,000. That tells me that this business is a risk. Look right up the top. What have we got? We got almost $7,000 in cash. Okay, that's a good start. At least we've got cash in the account. Look about halfway down the page. In liabilities, there's a business bank account. How can a bank account be a liability? I thought a bank account was an asset. This is probably an overdraft. So this says that I actually don't have $7,000 in cash. I've actually got about negative $10,000 in cash. So that's a worry. Artificially inflating how good this balance sheet looks even. I got $25,000 in accounts receivable. I can't go and pay my bills using accounts receivable. I can't give an unpaid invoice to an employee in terms of paying their bills. So there's a number of things that are really sticking out here. There is PAYG withholding payable. That means there's tax debt to the ATO. Don't know how long that's been building up, but potentially there's interest on that. There's certainly interest on the business bank account. I've got $9,000 worth of bills to pay when I've got negative $10,000 to pay it with. I don't know, am I approaching my overdraft limit there? Quite possibly. Lots of things stick out. Now that no one's been brave enough to put their hand up for it. There's a thing about halfway down the page in current liabilities called historical adjustment, and it's $19,000. And sure enough, it was $19,000 the year before. This is an error. This is not a real liability. Or is it? We just don't know. But anytime you're seeing something like that sticking out in your own books, and that's why I encourage you to go check your balance sheets after this call. If there's things on it that you can't understand, that is a huge problem. This is a massive, this $19,000 might be a liability. It might not be. God only knows. It might be potentially covering up another issue. There are just so many things that could be wrong with this balance sheet that I really encourage you to speak to a professional accountant if you see these things that you can't understand. It's almost your obligation as a small business owner to know what's going on, because if you don't know what's going on, you can't fix it. So what are we looking out for when I work with my clients to assess a balance sheet health? Cash is king. I think that's a common theme throughout this. I look at cash and I look at what can be readily convertible to cash, because I know that I've got to pay my bills using cash. Like I said, can't do using invoices. What we call the current ratio, if you take away your current liabilities from your current assets, that's a super important thing. It says, okay, in the next 12 months, am I going to kind of come across any big issues, any dramas? Super important, actually more important than the overall current, the overall net asset position is your current asset position. Is your equity building over time? Ideally, every year that you make a profit, that equity increases. It's telling you that you've had a good sustained growth period. You've every year you're making more money, ideally. So that equity growing is a good common sense check. So here's just some very obvious examples. If sales are good and cash is bad, it's going to be an issue in invoices. It's going to be an accounts receivable problem. So what do we do with that information? We don't just do nothing with it. We look at how we manage our cash flow. Likewise, if we've got strong growth in sales, but cash is sinking, could be about terms. So we've got 60-day here. We've already seen some horror stories in the chat about 90-day terms, which do happen. It's just a reminder to really look at your terms, and where possible, where you have the ability to actually change those terms, you should look at them. Not to say you'll be able to make a change, but you might be able to. So how do we use all this information? Great, you've now got the Duolingo version of the accounting language. You know enough to get yourself into trouble. What do we do with it all? How can you budget for next year if you don't understand this year's P&L? It's impossible. I'm not saying that next year is going to look exactly the same, but God, it's a good start, isn't it? It's a good baseline when you're budgeting for next year is, how have I gone this year? How did I go the year before? And then you tweak it. Don't reinvent the wheel. Don't do a budget with a blank piece of paper. Do it starting from last year's P&L. Identify what you can cut in expenses. Identify your revenue growth expectations based on whatever it is, your new product that's coming out, or if you've moved to a better shop front. If you can understand your historical, results, it's going to help you build and anticipate your needs. So that's really, really useful. In terms of getting ready, what can I do with these three reports now I understand them? Maybe you've identified that actually you're going to have a short-term need for cash. Maybe when you've done your budget based on last year's P&L and you've looked at your cash flow statement, you know that in April, you're going to need $500,000. Well, okay, I don't have $500,000. Let's get you ready to meet those challenges. If you go out to a bank and if you provide them projections based on a current balance sheet, your point in time, this is my balance sheet today, this is last year's P&L, this is next year's budget, which is realistic and based on last year's P&L. Here's my cash flow statement that explains, because the bank's question was going to be, if everything's so great and rosy, why do you need lending? Well, okay, let me show you. Here's our cash flow statement. Here's the period at which we're going to be underwater and I need the $500,000. Using my cash flow statement, this is how I'm going to pay back that $500,000, whatever it is, over 5 years. And it just shows a level of maturity. It's not, you're not going to the bank out of desperation. You're not a sinking ship. You're not, give me $500,000 to pay my bills because otherwise I'm going to be broke. It's, I've identified a short-term need for cash. I am a good business. I've improved. I've shown growth. I've shown tightness with expenses. And I can show that I can service a loan. That is going to get you the loan, where just a jumble of nothing or not being able to answer questions because you don't understand your financial reports is going to come a cropper. Likewise, if you're going out to investors, the question is always, if the business is so great, why do you need funds? Wouldn't you rather keep 100% of the company rather than sell me 10% of the shares? Again, you're identifying short-term needs, but you've got a fundamentally good business. So that's why these reports are so useful to help you prepare financing decisions. And as well, the process of actually generating these reports, the process of understanding your company's finances is incredibly important because you've armed yourself. You now speak a language that you didn't before. You've understood your business better and you can explain it to other people using a common language. It's also really, really helpful to get you ready for tax time actually as well. If you are in your books, if you're preparing these reports, if you're identifying things like that 19,000 historical adjustment, if you're identifying these errors and things that you can improve, you're going to be ready for tax time. You're going to have taken the razor to your legal expenses that we looked at before. But when you've done that, you're going to make sure that the invoices are in there. So all of these things, keeping your books reconciled. In Xero, when you log in on that dashboard, here are your 3 bank accounts. There are 20 transactions. Reconciliation, it's a complicated word. It just means telling Xero what it is. And it can auto-reconcile some things, but some things it won't know. Tell Xero what it is. Nice and straightforward. Then when it comes time to do your tax, it'll be ready to go. Why is that important? Well, your business might be due a tax refund. You never know. You might have been paying quarterly installments towards an expected tax bill of 100 grand. Didn't have a great last couple of quarters. You only actually need to pay 50 grand. Well, you've already paid 100. You'll get a refund of 50. Let's get your tax return in tomorrow. Then let's not sit, if you're a normal business using an accountant, you don't have to lodge till the May after the financial year's ended. Well, that's crazy. That's money that's sitting there on the table. Let's get you lodged quickly. By being involved in your accounts and looking at your reports, for a start, you should be able to know, and your accountant certainly will know, that that tax return is going to be a refund. And also, because you're in the books, everything's up to date, everything's reconciled, we can get your tax return done quickly. There are some red flags that we're going to watch out for. These are very, very obvious. If your cash flow is negative, if every time it's negative, we're not talking about short-term blips or anything like that. We're now talking about a sustained business problem. Your margins are going down. Inventory on your balance sheet's going up, but your sales don't match it. You're sitting on dead stock. These things are only things that you will actually notice if you run your accounts. When to get help? Whenever you can't be, or whenever you don't have the time or the expertise to handle things yourselves. I always recommend business owners give it a crack themselves because it will help you understand, but don't give up when it's too complicated. When it's too complicated, come to us. If you can't understand your reports, or if you can't explain them to others, you need help. There might be errors, or you might just need some help understanding. If you feel like you're flying blind, if you don't know enough to make important decisions now because you're not sure about your financial health, you need help. And of course, more importantly, if you're not sure if you're solvent, you urgently need help. Let's get you out of trouble. So what are the final takeaways from this? Just a recap, the P&L, what does it do? It shows you your performance over a certain period, and it's very, very simple. Top line revenue, in the middle, gross margin, at the bottom, net profit. Very, very straightforward. Balance sheet, what does it show you? It's your financial position in time. It's what you've got and it's what you owe. These takeaways, I'll leave you to read yourself, but my most important takeaway from all of these things is always try and teach yourself. Learn a little bit. You don't need to become an accountant, but learn, do your own research, understand the basics. If you understand the basics, get someone else to take care of the important stuff. Get professional support to do the complex stuff. But there will never be a time where you won't need to understand the basics yourself, because we as accountants can only really advise you properly if we understand your business and you understand your business better than anybody. So do dip your toes in, get the important stuff done yourself, and save a bit of coin that way, and then get the complex stuff done by others. And we would love to be the others, but make sure you do go out and get that support. Speaking of advice and support, I'll just quickly hand you back to Connor.
Cool. Thanks, Tim. It's plain English back on the screen here. So I forgot to mention when I introduced him earlier that he's also our resident comedian. I was remiss to say that. Awesome. Before we jump in the Q&A and on the Q&A, guys, obviously pop in your questions now so Tim can answer them. Perfect question, I'd say, from yourself, Ashley Martin. Just a bit of background there on your business is really, really helpful. So even if it's actually not about today's content, but it is an accounting or tax related question, feel free to drop that in the chat there as well. So before we do wrap up, I do want to quickly share how Lawpath can obviously support you beyond today's webinar. Obviously, looking at some slides, attending a webinar and understanding your numbers is one thing, but having one of these guys, having an expert in your corner is a real game changer. So there's kind of two things we're well known for. The first one would be the company registrations we do. We're Australia's largest incorporator of new businesses. But then the second thing would be these subscription services that we offer. And while we do things on an ad hoc basis as well for those who need it or need more specialized advice, what people really benefit from a cost saving and convenience and time would be things like the accounting advice package you see on the screen here. So what you get with this throughout the year is unlimited 30-minute consultations with our qualified accountants. These are generally done either by phone or video whenever you need them. So typically what people will ask us questions on is bookkeeping, their accounting software, when they're unsure how to handle payroll, trusts, a tricky tax situation. Probably one of the biggest ones is those tax minimization strategies people want to get advice on. You'd simply book in a call through the platform, get some clear answers, nice and fast. And if you were unable to book a call, there's also a live chat access there as well. And then we have the tax compliance plan there. So that's if you actually want us to do the work for you, all that hands-on work, the quarterly BAS statement. So obviously we're coming up to BAS at the end of February now, as well as the annual tax lodgements, financial statements, all that good stuff. Probably one of the best aspects of that particular plan is not so much the hands-on work, but one of the big issues people tend to have with their accountants is they find they're chasing them. With the tax compliance, it's the opposite. We chase you, and we're quite proactive there to get all the information we need to do ahead of those lodgements. And then just finally, so it's the clues in the name of Lawpath. We're not just the tax advisory and the accounting stuff. We also provide template library of 500 plus documents, and the same concept, unlimited consultations with our lawyers on hand. And what we do is we have a few standalone options if you just want to have a few items in there, or you can actually bundle everything together for best value. In a nutshell. If anyone does have any questions on those, happy to have a chat with you after the webinar if you want to see if it would be a good fit for your business. And likewise, if you do want to have maybe of a taster, especially with the accounting and tax services, just type yes to have a free call with one of our accountants in the chat, please. And finally, we do have an exclusive offer. So there is 10% on the annual tax plan. So really ideal timing with, as I mentioned, the BAS coming up in February and all the reporting in June. Cool. So we've had some questions now in the chat. I'll hand things back over to Tim.
Thank you very much. Guys, we have plenty of time to handle some questions. So if you've got more, please do drop them in. But I'm going to go back to the start. I think I'm up to 12:17 when we got the first questions. So I think it's Jacomi, and I apologize, I butchered the pronunciation there, has asked, if you're a software startup, wouldn't you include wages in COGS or cost of sold rather than below the line in operating expenses? Yeah, I probably would. The best part about the profit and losses, it's yours. You can actually, for a small business where you've got basically no accounting standards to follow, you can absolutely say, well, some or all of my wages are core expenses related to product. So you'll see lots of businesses will split their wages and count some of it as cost of goods sold, and some of it will be considered operating expenses that are sort of there regardless. So your CEO wage might be an operating expense, your sales team wage might be in COGS. So it's very flexible to run it the way that you want to run that. Ashley Martin has asked, how do you calculate gross profit margin? The 50% one that I talked about, that is your gross profit divided by your revenue. So if you had $100,000 in income and $40,000 of expenses, you would have $60,000 of gross profit. And the margin would be 60%. 60,000 divided by 100,000. Good question, Ashley. Go through them. Peter's asked, cost of sales, are they usually direct costs that vary with the volume? Yes, typically. Typically they are. In fact, the example that Peter's given, which is ingredients and things like that. Yes, typically cost of goods sold are costs that will vary with the amount of revenue. Ashley's come back again. Great question again. Running an analytical laboratory. That sounds exciting. So if revenue is highly influenced by season and forecasting is difficult and inaccurate, yeah. So it's actually in your sort of industry, that's where forecasting is all the more important. Seasonality, you can certainly map. So you'll know when the rains are coming, depending on where you are, with a degree of certainty. Not certainly with absolute certainty, but you'll basically understand that, well, this quarter is going to be tough because we know that the weather's going to be bad, or we suspect that it will. You can do what's called, you can have some sensitivity analysis in there where you basically do 3 versions of a forecast. One where there's 20 rainy days, one where there's 10, one where there's 0. So it gives you options, and it shows that you thought about what you've done. Of course, forecasts are always going to be subject to acts of God, but to the extent that you can map seasonality, you absolutely should, particularly for cash flow purposes. You know that you might have been profitable this month or this quarter, but you know that you need that cash in the bank because next quarter is going to be rubbish. So great question, Ashley. Thanks for that. And someone's actually helped you out there and said that Xero does have links to analytical services, which it does. Warren's asked, as a business owner, I use owner drawings to pay myself, but it doesn't show up in the P&L. So therefore, how can I get an accurate net profit position? Yeah, good point. As a business owner, you've got the option. You could, if you're taking drawings that will later be converted to something else, if they're basically salary, you could put yourself on salary and it would show up as net profit. If it is true just equity, if it's true retained profits and you can pay it in or out, it shouldn't be on a P&L because it's not actually an expense. It'll show on your balance sheet in that owner's equity section that I rushed through because people don't care. If you're taking drawings out, it'll show on that point. So for your own purposes, again, it's your P&L. You can record your owner's drawings as an expense if you want. Just, your accountant will know to take it out and make sure it's not a deduction. But if for your purposes, it's helpful, it would be more helpful for you to see your drawings in the P&L, put them in there. Completely encourage you to do that. Mark has asked, are you aware of any software that will undertake ABC. This is probably the subject I did worse in university. So this is a real management accounting thing. Activity-based costing is a way of really forecasting to very minute levels of detail component costs and breaking down and looking at your margin that way. It's not my forte. I imagine that most small business accounting services, software services won't do ABC. I imagine you'd have to look for quite specialized, particularly inventory specific software. But please email me if you find something good. A few more comments in here. I'm just fast forwarding. Got some more questions about SaaS startups. We love SaaS startups. So if you've got, the question here is, for a SaaS startup with pay in advance annual subscription-based revenue model, very familiar with those models, which accounting method would be most appropriate, accrual or cash? This is a real nerdy question. I love this one. I would say the accruals basis is most accurate from an accounting perspective. And that is really a good reason that you should also be doing cash flow reporting, because for anyone that doesn't know, accrual is the accrual concept is the idea that you split your revenue as you deliver it. So in this case, if this company was charging, pardon me, $12,000 a year, from an accrual perspective, we would say that, well, January is 1,000, February is 1,000. We'd split it because we'd say, well, they've paid for the subscription for the whole year. We should be delivering $1,000 of revenue per month. It's very important in that scenario. So I do think you should do accrual basis, but also you should be running a cash flow report that says, we've got that cash. We've got the 12,000 now. There isn't another 12,000. There isn't another 11,000 coming in the rest of the year. So that would be my input there. Great question. Irina, or apologies again on the pronunciation. With a new business starting up, when should you be expecting to run at a profit? There's no one answer to that question. Although what is relevant is the idea of runway. Now you hear a lot of startups talking about runway and burn rates and things like that. It's important that your business can be profitable before that runway runs out. So you should know in your forecasts that I'll be able to sustain a loss of X amount and my cash runway will run out by May 2027 at this rate. And that's something that you don't just set once, you constantly review it. So when should you be expecting to run a profit? Ideally day one, but which business is like that? You should have a roadmap that says, I'm expecting to turn a profit here. And at that point, I've still got cash left in the bank. So I'm sorry, I can't give you a more precise answer there. As an owner, what is better, taking dividends or drawing a salary? I did a whole webinar on this topic. I thoroughly recommend you go and watch it. There is no one right answer. There are pros and cons to dividends and salary. Salary looks better to banks if you're looking out to get a mortgage. They understand salaries better than they understand businesses. Dividends has more tax flexibility and delays in paying. You pay tax on dividends later. So it depends on your purpose, but please do go and watch that webinar. Taylor is saying record sole trader owner wages in an owner wages expense account, so it doesn't come out as drawings. I think that was more of a comment actually based on an answer I gave previously, which I think is a fantastic way of doing things. Whether it's actually wages or not, you can record it as wages if it helps you track your business in the P&L, and your accountant can do what we call general journal entries at the end of the year to move it back into owner's equity where it should be. So thank you for that feedback. Julian said, I've been on cash basis for 7 years. How do I switch to accrual? You just do it, actually. You don't even have to tell anyone, I don't think. You can just, as long as there's no tax implication in terms of your net tax position, I believe you can just, on your next tax return, record it as an accrual basis. I don't think you need to actually do anything special, but I would recommend just having an accountant help you make the switch, just because it can be a little bit fiddly. Only once. It's only difficult once. Once you switch, it's really straightforward. I actually think most businesses should be on an accruals basis these days anyway, and the ATO does tend to agree. Tanya's asked, please advise of the percentage that would be considered a good gross profit percentage for the construction industry. Construction industry it's probably one of the most difficult to comment on, because actually there are very specialized construction accounting firms. The reason being is that the margins are a knife edge. So unlike most businesses, you go back to my bakery or bread shop, as I called it. If you go back to your bakery, if your margin is 1 or 2% different, it's a matter of cents. When we're talking construction, tiny changes in margin can mean the difference between you driving a Ferrari and you being in jail for, deliberate avoidance of director's duties. So I wouldn't dare comment on a good construction industry gross profit, just because the sheer dollar value involved if you're off by a couple of percentage. I would say make sure you do really, really good forecasts, and that sensitivity analysis, understanding that construction industry wages went through the roof, materials costings are highly subject to international market forces, and as anyone that reads the news would know, that's going a bit bananas at the moment in terms of tariffs and things like that. Make sure you've done your sensitivity analysis, have your baseline, but understand, well, what are things going to look like if my cement costs go up 10%? Having those sort of sensitivity analysis is really, really important in that industry. Sorry, I can't give you an exact number there. We've got another question where the owners are not taking a salary. Should the liability be recognized for the services? Ooh, it's a good question. If the liability exists, it should definitely be recorded, but the liability in that case would only exist if there's an agreement set in stone to pay them at some point in the future. What you're describing there is more like a situation where you're generating profits, and at some point, maybe cash flow permitting, those profits will be paid out to some of those people that have been working in the business. In that scenario, that is not a liability. That sits there in equity as a profit until it's reduced by declaring a dividend. So that's the right way to record that. Warren's asked, how can I get some benchmark data to compare your P&L with similar businesses? The ATO actually puts out this data. Or it might be the ABS, the Bureau of Statistics. I think it might be both of them, actually. If you search for ATO benchmark data on small businesses, you will see that they do actually publish that information based on anonymized aggregate data from tax returns lodged. And actually they break it down by size of business as well in some pretty broad brush strokes. So Warren, that's probably your closest source of truth there. Assuming everyone was honest in their tax returns, which I'm sure they were. Certainly my clients are. We might have run out of questions. We have. I'll give you 1 minute before Connor takes over. This is your final chance to ask a question before I see you next time. I'm back in. We've got another couple of webinars that I'm on. Look up the schedule on the website. We've got some interesting topics coming up between now and March. I think we've got about 4 of them myself. But come along to the legal ones too. They're cracking. I will pass you back to Connor.
Awesome. Thanks, Tim. And thank you for everyone for attending today. Just a reminder that all these webinars are recorded. They do go onto our YouTube page. So today's one should come on this afternoon, if not tomorrow at the latest. Earlier, we did share the webinar on Directors ID if you want to check that out. But would also recommend, we've got some webinars and other videos on actually registering companies, Setup 101, and a few other related videos you might find useful. Not all videos are actually, 45-minute webinars. We do have some bite-sized, shorter 3 to 4 minute videos as well if you want to just quickly digest a few accounting tips in there as well. So that's it from myself. Hopefully we'll catch you guys on future ones. I did just quickly plug in there on the chat, if for those of you who are unsure on your business structure, or you even have an ABN and are considering making a switch to the ACM, feel free to email me for any further information. We do offer a free of charge service to go through the ASIC form as it appears on our website. Not the majority of the time, but enough that people do sometimes make mistakes when they actually register a company. So we'd love to help you avoid any where we can. Awesome. I think, yeah, no more questions. Beautiful. All right. Thanks, everyone. Hopefully we'll see you again next week. Cheers.
Thanks, everyone. Bye.